Headlines right now are flashing deep red. Rising geopolitical tensions are threatening the global energy supply. Tech stocks are bleeding out after the holidays, and a dismal jobs report is waving a recession warning sign. While headlines scream about a crash, institutional capital is quietly rerouting into hidden channels that retail investors are currently ignoring. The market has splintered into hidden institutional realities that average investors are completely missing. This is the great market pivot. Surviving this new landscape requires looking past the screen and tracking three distinct physical shifts happening right now. And the first shift starts out on the ocean. For months, the dominant fear was that Middle East conflicts would trigger severe global oil shortages. Instead, WTI crude just plummeted straight back down near $68 a barrel. The catalyst traces back to a major logistical choke point. The Strait of Hormuz has reopened. This unleashed a tidal wave of trapped oil tankers. Hundreds of vessels are pouring out of the Persian Gulf, flooding the ocean with supply. This chart tracks WTI crude prices over recent months. You can see how this sudden, massive supply wave completely erased the elevated pre-war pricing, driving the line straight down to the $68 floor. Retail investors who bought oil stocks based on outdated supply shortage fears are now caught completely off guard by the physical reality of global shipping logistics. A similar miscalculation is happening in the stock market. With consumer tech heavyweights facing sharp profit-taking corrections over the last few sessions, many are rushing to declare that the tech bubble has finally burst. Billionaires aren't abandoning artificial intelligence. They are migrating upstream. We are entering the AI CapEx cycle, a phase where capital is leaving intangible software and flowing directly into physical infrastructure. The first major requirement for this shift is raw energy. Massive, uninterrupted power generation is required to keep complex artificial intelligence models running at scale. The second requirement is the physical architecture itself. Capital is pouring heavily into dense arrays of server racks and hardware needed to process the data. Wealth is transitioning out of software and into the concrete, steel, and raw energy required to keep these systems alive. Domestically, the Federal Reserve is navigating a set of sharply conflicting data. Last week's employment report was catastrophically weak, showing only 57,000 jobs created against expectations of 110,000. This visualization highlights the conflict. Plummeting job growth points to a slowing economy, yet latest data shows inflation stubbornly stuck at 3.5%. This contradiction stems from a fragmented consumer base. We are operating inside a two Americas economy. Lower and middle-income households are facing a massive squeeze on their purchasing power, forcing a severe pullback. Meanwhile, top earners are keeping retail sales entirely resilient, spending aggressively on services and luxury goods. This dynamic neutralizes traditional central bank levers. Interest rate hikes struggle to stabilize a system where wealthy consumers single-handedly drive up prices, while middle-class hiring stalls. The illusion of a single, unified global economy that rises and falls together is giving way to a more fragmented reality. Broad headline economic data now obscures the actual underlying movements taking place in physical shipping lanes, heavy industrial power plants, and high-end consumer spending. Blindly relying on traditional index funds is a highly vulnerable strategy in an economy that has split entirely in half. To survive the great market pivot, you have to stop trading on yesterday's panic. You have to open the ledger and track exactly where the physical capital is flowing.